evening, everyone. We'll give it a few minutes while everyone else joins. Maybe in the meantime, we can start by introducing ourselves. Welcome, everyone, to our webinar, Unlocking Options, a beginner's guide to options trading. We're thrilled to have you with us today. My name is Faisal. I'm part of the Wealth Advisory team. I've been with Sarwa for nearly 3 years now, where I've had the privilege of helping clients navigate complex financial markets and achieve their goals and aspirations. My experience lies in fintech and spans across the US, Saudi, and UAE. I'm also a CISI certified in wealth and investment management. I'm joined by my colleague and co-host Michael, who is the head of investments here at Sarwa. I'll let him introduce himself. Michael, over to you.
Thanks. Welcome, everyone. Thanks, Faisal. My name is Michael Chu. I'm the head of investments. I've recently joined Sarwa. Previously to joining Sarwa, I was with a family office overseeing their investments. Previous to that, I was with a local bank on their investment product team. So I have quite a long career of managing investments. And yeah, I'm also a CFA chartered.
Wonderful. Thank you, Michael. And just before we begin, we have to go through some disclaimers. As much as we'd love to, we can't predict the future or use a crystal ball to know what's going to happen in the next few months or years. So all the views expressed here are for educational purposes and not intended to be a one-on-one advice. Please make sure to do your own research and your due diligence before making any financial decisions. And remember, all investments come with a certain level of risk. Now that's out of the way. This is the agenda for today. We're going to start by covering the basics of options trading, explore why options can be an attractive investment strategy, review some common option trading strategies. We'll also be giving you a demo of the Sarwa Trade platform, where you'll see how to place trades and access the available tools. And finally, we'll discuss pricing, some risks and warnings, followed by a Q&A session. So please feel free to drop your questions in the chat or the Q&A function below throughout the webinar. Make sure not to leave your questions as anonymous in case we run over time, then we have to get to your questions after the webinar. We'll greatly appreciate it. All right, now for the fun part. Michael, over to you.
Thank you. So I guess we'll start at the very beginning. So what is options trading? I guess first we should understand what an option is. So what's an option? So can you move the slide? There we go. So an option is a contract that gives you the right, but not the obligation to buy or sell an asset at a predetermined price by a certain date. A simple example would be if you want to go to a concert, you buy a concert ticket, but you want to buy that concert ticket, but you're unsure if you'll be able to attend. So you pay a small fee to reserve that option to buy the ticket at a fixed price next month. Now, if you decide to go, you buy the ticket at the agreed price. But if you don't go, you lose the reservation fee, but you're not forced to buy that ticket. So that's essentially what an option is. It just gives you the right, but not the obligation to buy. That example was a call option. So a call option gives the buyer the right, but not the obligation to buy the stock at a specific price before a certain date. And the buyer benefits if the stock price increases above the agreed price. I have an example. Let's say you were interested in buying a house for 300,000 dirhams, well, dollars, but you wouldn't be ready to buy it for 6 months. Now you can enter into an agreement, in this case, a call option with the person selling the house to purchase it for $300,000 in 6 months. If the property should, say, rise to $350,000 in 6 months, you can exercise your call option, buy it for $300,000 as agreed by the seller, and in turn, profit by selling it for $350,000. However, should the price drop below $300,000, you would simply let the option contract expire and you're not obligated to purchase the property. You would obviously lose the option premium that you paid for that. So that's how a call option would work. Put option. Now this gives the buyer the right, but not the obligation to sell a stock at a specific price before a certain date. The buyer benefits if the asset's price drops below the agreed price. In this example, imagine you own a car and you want protection in case its value decreases. You pay a small fee to get the option to sell it for $10,000 in 6 months. If the market value of the car drops below $8,000 in 6 months, you can still sell it for $10,000, protecting yourself from the loss. So if the car's value stays the same or increases, you simply don't use the option and lose only the small fee you paid for that protection. Strike price. So the strike price is the predetermined price at which the buyer of an option can buy for a call or sell for a put. The underlying stock, it's the price agreed upon when the option contract is created. Again, I have an example. Imagine you agree with a friend to buy their bicycle for $100 at any time within the next month. The $100 is a strike price. Whether the bicycle's market value goes up or down, you have the right to buy it for $100. If the market value rises to $150, you get a good deal because the strike price was $100. If it drops below $100, you might not buy the bike, losing only the cost of the agreed premium. Expiration date. In options trading, the expiration date is the last day on which the option holder can exercise their right to buy for a call or sell for a put, the underlying asset. At Sarwa, we trade American options, which means that they can be exercised at any time before the expiration date. After this date, the option becomes worthless. So let's imagine you have a coupon that allows you to purchase a pair of shoes at a discount, but the coupon expires at the last day of the month. If you don't use the coupon by that day, it becomes invalid and you lose the chance to buy the shoes at the discounted price. Similarly, with options, you must decide before the expiration date whether to use your right to buy or sell. What is premium? The premium is the price paid by the buyer to the seller for the right, but not the obligation to buy or sell an asset at the strike price before the expiration date. It's the cost of purchasing the option. So intrinsic value. So intrinsic value refers to the real tangible value of an option if it were exercised right now. It's the difference between the option strike price and the current market price of the underlying asset, but only when the option is profitable or in the money. Intrinsic value for a call option, the right to buy, intrinsic value exists when the current price of the underlying asset is higher than the strike price. The option's intrinsic value is the amount by which the asset's price exceeds the strike price. For a put option, the right to sell, intrinsic value exists when the current price of the underlying asset is below the strike price. The intrinsic value is the amount by which the strike price exceeds the current asset's current price. If the option is not profitable, meaning the price hasn't moved in the buyer's favor, the intrinsic value is zero, but the option could still have value from other factors like time. So now we have extrinsic value, also known as time value, is the portion of the option's price that exceeds its intrinsic value. It reflects factors like time until expiration and market volatility, which affect the likelihood of the option becoming profitable before it expires. So what is extrinsic value? It's influenced by factors like time until expiration. The more time an option has until expiration, the greater the chance that the price of the underlying asset could move in the buyer's favor, increasing the value of the option. Therefore, options with more time left tend to have higher extrinsic value of volatility. If the price of the underlying asset is expected to fluctuate significantly, there's a higher chance that the option could become profitable. Higher volatility means greater potential for price movement, and this boosts the extrinsic value. Interest rates and dividends, market factors like interest rates or dividends on the underlying asset can also affect extrinsic value because they influence the overall market conditions and expectations. So why would you trade options? Three general ways to use options. Hedging. Using options contract to offset potential losses in the underlying asset. This strategy acts as a form of insurance against adverse price movements. Example of protective put. Protective put involves buying a put option for an asset you already own to protect against a decline in the price of the asset. You can use options to limit your exposure. By buying or selling options, you can strategically limit your downside. Protective put or a covered call. Covered call, selling a call option on an asset you own to generate income and provide a buffer against minor declines. Flexibility. Options can be tailored to meet specific investment goals and risk tolerances, allowing for profit in bullish, bearish, and neutral markets. Buy a call option if you are bullish, buy a put option if you are bearish, and use a covered call strategy if you think the assets will trade sideways with limited upside. So commonly used strategies. So long call, it's just buying a call option, is a bullish option strategy where an investor buys a call option, giving them the right but not the obligation to purchase an underlying asset at a specified strike price before the option expires. Imagine you hear about a popular concert coming to town in a few months and you believe the ticket prices will go up as the concert date approaches. However, you don't want to spend a lot of money upfront to buy the ticket. You might be able to pay a small fee to the promoter to reserve your right to buy that ticket at a set price. If the ticket price doubles, you can buy the ticket at the set price, the strike price, as the promoter is obligated to sell it to you at that strike price. Long puts. A long put is a bearish option strategy where an investor buys a put option, giving them the right but not the obligation to sell an underlying asset at a specific strike price before the option expires. It's similar to buying a flight ticket for $1,000 and you pay a premium of $50 for the insurance that lets you cancel the ticket and receive 90% refund. If you see the price of the ticket drop to $800, you can cancel your ticket, receive a refund of $900, and buy the new ticket for $800. Your total cost would be $800 plus the $50 premium you paid, so $850. Covered call is an option strategy where an investor holds a long position in an asset, so you own the stock, and sells or writes a call option on that same asset. This strategy is typically used to generate additional income through the premiums received from selling the call option. The call option premium also helps to buffer any minor drop in the underlying asset's price. So imagine you own an LV bag that you bought for $5,000 and you think the price will appreciate in the future, but not by very much. You decide to sell an option to a collector for $500. This option allows the collector to buy the LV bag from you at a fixed price of $6,000. That's the strike price, anytime before the contract expiration. Now, the price of the bag will need to be above the strike price of $6,000 plus the premium paid of $500. So $6,500 before the collector will exercise their right to buy the bag. If the bag is now worth $10,000, you, the owner of the bag, and the seller of the option will only make $6,500 as your upside is capped. Now, if the collector does not exercise the option and it expires, you, the seller of the option, keep the bag and the call option premium of $500. So that's the extra income you earn from selling the premium. Protective put is a risk management strategy that involves holding a long position, so owning a stock in an asset, and buying a put option on that same asset. The strategy is used to guard against potential losses while still allowing for upside gains. So you own an iPhone and you pay a premium, a put option, to buy insurance for your iPhone that gives you the option to sell it at a set price, the strike price, in a year's time. If that iPhone is less than your strike price, you can exercise your put option and sell your phone at that predetermined price. That's how a protective put works, to protect that asset you already own. Cash secured puts is an option strategy where an investor sells, writes a put option, and simultaneously sets aside enough cash to buy the underlying asset if the option is exercised. This strategy is often used to generate income or to potentially buy stocks at a lower price. We can go back to the example of that LV bag. That same bag you bought for $5,000 and now the collector owns. You talk to the collector and sell him an option for $500 that says you will buy the bag for $5,000 within a year's time. And you set aside $5,000 as you're now obligated to buy that bag. It's now summer in Dubai and the demand for LV bags is very slow and the collector can't sell the bag for any price and no one's around shopping. So the collector exercises his option to sell you the bag for $5,000 as he needs the cash. So that's the cash secured put. Once you sell that put, you are obligated to buy that asset.
Thank you, Michael. That was a great walkthrough. And now that we've got or covered the foundations of options, I'll try to throw in a pun there, but not sure everyone's gonna get it. We'll take you through a quick demo right now to show you the functionalities and order types available in Sarwa Trade. We'll also cover how to place an options trade, the various types of orders you can make, and how to navigate the platform to take advantage of these features. So let's jump into the demo. Just one more note, our VP of Advisory, Ayman Gebri, who you've seen before, is going to lead the demo. So on to the video. And one more note, please feel free to leave any questions you have throughout in the chat box or in the Q&A function.
Hi, I'm Ayman Gebri, VP of Wealth Advisory at Sarwa. Today, I'm going to walk you through trading options on our platform. I'll explain what you see on screen, what everything means, and guide you through an example of buying a call option. So, let's start with the basics. Buying a call can be beneficial if you expect the stock's price to rise. First thing you'll need to do is activate options trading on your account. For details, refer to the FAQ page in the description below. Now, once that's active, you'll go to the Trade tab on the Sarwa app and find the stock you're interested in trading. Now, for today's example, we're going to use Tesla. Now, when you choose Tesla, a new window will pop up that will give you information about the stock. Next, you proceed to trade. Once you select trade, a menu will open that provides you the possibility to buy, sell, what we're looking to do today, options. A new window will open up, providing you with a menu of opportunities for you to go through with options trading. At the top, this is where you select the options contract expiry date. Next, you'll see below the option to either buy or sell a contract. And right beside it, you will see the option of call or put. So let's just say that you're quite bullish on Tesla. You can see that the current price is right here, and you feel that the price will go up at a certain date in the future. You would first choose the expiry date here, then you would choose buy, and in this section, you would choose call. Now you've decided on the expiry date that you're going to buy a call option because you believe the price of the stock will go up by then. But as you can see, there are multiple options contracts on the screen, each with varying strike prices. The goal when buying a call option is for the market price of the stock to rise above the strike price you've chosen. If this happens, the option is considered in the money, meaning you have the opportunity to buy the stock at the lower strike price and sell it at the higher market price, capturing a profit. You're also going to see a bar that shows the current share price of the stock. For example, for buying a call, contracts above this bar are considered to be out of the money, while those below are considered to be in the money or at the money. Another detail to note is that for each options contract, you can actually see how much the stock needs to move in order to reach the break-even point. This is essentially where you make up the cost of the premium if the contract expires. On the right-hand side is the premium that you're going to be paying to purchase the options contract. The premium is essentially the cost you pay to purchase the contract. Below the premium is today's change in the premium's price. Now, keep in mind that when you're buying an options contract, you are purchasing in lot sizes of 100. This means that you will be exercising an option to purchase 100 shares of the stock. Let's quickly summarize. We've decided on the expiry date, the strike price, and we've reviewed the price of the options contract. We are ready to proceed with executing the trade. Once you choose the options contract, you'll be taken to a page where you can find information on previous closes, daily highs, daily lows, and also key metrics like the Greeks, which help you understand the risks and potential changes in an option's value. You can also see the bid-ask spread of the premium and the implied volatility, which essentially measures how much the market expects the stock price to move in the future, which of course is a key factor in determining the price of an options contract. Once you've reviewed this, you proceed to buy. Immediately, you'll be provided the option to choose the number of contracts that you would like to purchase. Remember again, one options contract means that you'll be exercising an option to purchase 100 shares of the stock. Now, for this example, I'm going to choose one contract for illustration purposes. Below order type, you can choose to either buy the option as a market order, or you can use a limit order. Now, by default, we do set options to a limit order because while market orders are executed quickly, there's no guarantee of a specific price. So we do recommend limit orders to avoid significant price fluctuations, especially for options which often trade with limited volume. By default, for limit orders, the bid price applies for selling and the asking price applies for buying, but you can always change it. Please note that limit orders may not always be executed if the market doesn't reach your specified price. After submitting a limit order, simply refresh the homepage to check its status and see if it's been executed. Congratulations, you have now purchased the call option through Sarwa Trade. Now, on your trade homepage, you'll see a list of options you hold, along with their performance. Now, to view details about a specific options contract, just simply click on it. This will show you the actions you can take, such as exercising the contract or trading it. If you want to sell a long call, for example, you would click Trade, select Sell, and enter the number of contracts you'd like to sell. Platform will very intuitively display the potential earnings from the sale. And that's all for this video. Happy trading.
All right, thank you, Eamon. Now on to pricing. So as Eamon briefly mentioned, there are essentially two prices you should be aware of. One is the contract fee or the commission fee, which is $4 per contract for buying and selling, as well as the commission fee, which is essentially $1 or 0.25% of the total traded value, whichever of the two is greater. And then just some risks and warnings to be aware of when trading in options. First, it's important to understand that the high risk nature of options trading. Leverage can magnify both returns as well as losses. So for example, in an uncovered call option strategy, if the market moves against you, your losses could be unlimited. So stock prices can rise indefinitely, which means potential losses can also become. Another factor is high market volatility. As Michael alluded to this earlier, option prices can be more volatile than stock prices, and this can either work for or against you. It's important to be aware of the extreme price swings that can occur. Additionally, options are complex financial instruments. Some strategies are so advanced that even experienced investors can find them challenging and hard to implement, and losses can become significant if things go wrong. And finally, there's a time value decay. The time value of an option contract decreases as it approaches expiration. This decay can erode potential profits, especially if you're holding on to an option for too long. So that pretty much concludes the main portion of our webinar. We hope that you enjoyed the session, and we'll open it up for Q&A right now. So I'll quickly scan through the questions if you had left any. It's not too late to leave more questions. So please feel free to do so. Michael and I will be here to answer as many as we can. All right, so let me just go to the Q&A. All right, so we've got a question from Swaminathan. Can we trade index futures options like NQES Mini? See. I'm honestly not quite sure about this. Michael, are you familiar? If not, we can get back to you after this webinar and respond to your question.
Yeah, at this moment we can't trade mini futures. It's just individual options on individual stocks or ETFs that are on our platform.
Thank you, Michael. All right, so we've got another question from Mazen. So to buy option for $100 stock, I will need to pay $10,000 when want to execute this option before it expires. Okay. I'm not sure if I understood the question. So to buy options for $100 stock, okay, I'll need to pay $10,000. Yeah, essentially, if the stock is valued at the time of the strike price for $100, then that will be the total value, plus the contract fee and the commissions paid on top of that.
Yes. But on that point, you do have the right to sell your option before expiration. So if the underlying stock price has increased in value above your strike price, so now you're in the money and you feel you could your option is either exercise at that strike price or sell your option and profit from the increase in price from the option.
Great. Thank you for that, Michael. We have a question asking, please brief us on the tax implications of trading in options. Michael, correct me if I'm wrong. As far as I know, there aren't any additional tax implications for trading in options beyond the regular tax implications for trading stocks in general. So that we have a dividend withholding tax, which doesn't apply in this case, unless you own that stock after. And then we have capital gains tax, which is dependent on your residency. And then we have estate taxes, which apply if you have US domiciled assets. But beyond that, there shouldn't be any additional tax exposures. All right. We have another question asking us to elaborate with an example. Muhammad, if maybe you can ask us for a specific option type or a specific type that you'd like us to elaborate with an example, we'll be happy to do so. We have another question from Raja. What is the minimum capital required for options selling?
So that would be the cash secured put. You want to sell a put. Well, if you want to sell a call, you have to own the underlying. So you need to have at least 100 shares of the underlying stock you want to sell a call option on. But if you want to sell a put, so that's a cash secured put, you need to have the equivalent amount to 100 shares of that underlying stock. There will be a block on that amount, so it is secured in case that the buyer of that put option exercises the right to sell you that stock. So cash secured put is a good way to buy a stock at a discount. If you think NVIDIA is going to, maybe you're hoping NVIDIA trades maybe 10% below at its current values, you could sell a cash secured put at 10% less than the current price now as a strike price. And if it goes below that, the buyer of that option would exercise, and then you would end up owning NVIDIA at that strike price. But if NVIDIA price does not drop below the strike price, then you've collected the option premium for selling that put.
Thank you, Michael. All right, let's jump to another question. Right. Okay, we have a question from Rihan asking, could we not use options as safer way of trading, as a lot of people use options as a way to hedge? I wouldn't say it's a safer way of trading per se. It usually entails higher risk than normal trading in stocks, buying and selling. So I wouldn't say it's necessarily a safer way of trading. Michael, would you want to add to that?
That example I used with the cash secured put, if you have the intention to buy that stock, but you want to buy it at a lower price, you could use the cash secured put strategy. So you would collect the options premium from selling it, and then or you get the stock at a cheaper price. The other option of hedging and protecting and gaining some income is a covered call. If you own that stock and you want to make a little bit of income, you don't think the stock's going to go up very high, that's a covered call. And then you get a little bit of buffer on the stock price movement because you've collected that options premium. Now, if you want more protection than the call option, you can actually buy a put option on that stock that you own. So that's a protective put example we shared, where you own NVIDIA and you're worried that the share price will drop 10 or 20%. So you would buy a put option at that strike price that you're concerned about. And that essentially is buying insurance that, to ward against that share price dropping below that strike price.
Thank you, Michael. We have a question from Hadi. Hadi asked, what amount do we pay at the time of buying the option? Is it strike plus quantity plus fee? When executing, do we pay the strike? The premium plus quantity, premium times quantity plus fee?
So you want to take that one?
Sure. So at the time of buying an option, basically you'd be paying the contract fee, which is $4, and then the premium plus times the quantity. So yeah, exactly how you mentioned, Hadi.
And just remember that one options contract is 100 shares. So what you see as the premium price, that's multiplied by 100 and plus $4.
Right. And then we have a follow-up question to that from Mazen. His question asks, if I execute the option, will I own 100 stocks in my account? Yes. So if you're buying, if you end up buying the option, then you will end up having 100 stocks, correct? All right. We have a question from Anonymous. If I get dividends, I usually pay taxes on these. Do I pay any tax if I am a non-US resident when it comes to options trading? And two, what are the fees and commissions, again, that Sarwa takes for options? Is there a minimum amount of money to do option trading at Sarwa? So for one, we covered this previously. There aren't any additional tax exposures when you trade in options. So if you do end up owning the stocks, you will, and they pay dividends, you will be taxed on those dividends. So no additional tax implications beyond the normal ones. And then for two, for the fees and commissions, I can just go back to that page real quick. So there are two fees you should be aware of, which is the contract fee, which is $4 per contract, and buying or selling, and essentially the commission fee, which is $1 or 0.25%, whichever of the two is higher. All right. We have a question from Mikhail. Any options available on crypto? Great question. As far as I know, not at the moment, not on our platform, but hopefully maybe in the future, it's something that we can explore, but not at the moment. Okay, we have a question asking us, in the Sarwa app where it shows the performance profile, before you complete buying a call option, what does the break-even price mean? Michael?
Sorry, what was it?
So before you complete buying an option, what does the break-even price mean?
Your break-even price generally is your options premium paid plus or minus your strike price plus or minus the options premium, depending on what you're trying to execute. So if you buy a call option and you want to see that the share price of that stock is higher than the strike price by at least that option premium amount, or else it doesn't make sense to execute that option. And the opposite would apply if you bought a put option. It would have to be lower than the strike price plus that options premium.
Thanks for that, Michael. All right, we have a question from Anonymous. How does complement Sarwa's initial mission of long-term investment? Great question. So, as you know, Sarwa, specifically Sarwa Trade, is continuously growing and expanding our set of tools and our set of features. So we're continuously growing and developing the platform to meet our clients' expectations and their needs. So it's an evolving platform and evolving functions and features. So that's just a continuation of Sarwa Trade's evolution, which is to include options. And hopefully we'll be adding more in the future, either more features and functions, more markets, and so on.
Yeah, just to add on to that point, for long-term investors, if you're holding an asset and you want to generate a little bit more income in terms of options premiums, you could sell call options on a regular basis to generate additional premium revenue. So that is what a lot of clients that are holding stock portfolios or ETF portfolios, and they just want to generate more income because they don't think that underlying is going to appreciate that much. So they're not going to get capped out or called away. And vice versa. If you are holding those assets and you're concerned about market volatility, a massive drawdown, that's where you could buy some put options to hedge against downside risk. Of course, it really depends on what your view is on the market or on your investments.
Thank you, Michael. All right. So a continuation to that question, or a relevant question to that, is, are there plans to add advanced options trading chains such as Iron, Condor, Straddle, etc.? So again, we are always looking to improve and add additional features and functions. So yes, nothing is impossible. We can for sure explore these down the line. All right. We have a question here from Mazin. So I can sell the option like selling a stock. So if the stock rises to $1, then the profit will be $100. Not sure I understood the question. Michael, do you?
That was...
So he asked, can I sell the option stock? So if the stock rises to $1, then the profit will be $100. I guess it depends on the order type and the strike price.
Yeah, but it's essentially the math works because one contract is equivalent to 100 shares. So whether you're buying or selling, which side, every dollar you're in the money equates to $100.
Okay. All right. Can you give us an example for long put and protective put?
Example. Yeah, so that long put would be if you own NVIDIA and you're worried that maybe in the next 2 months' time that the share price could drop by 10%. So you would buy an option with a strike price at 10% of today's current price with an expiration 2 months out. And that would be your put option to give you that 10% buffer. If the stock drops below that, then you exercise that put option, and the seller of that option is obligated to buy NVIDIA at that strike price. So that's when you would exercise that option. The next protective put would be if you own that asset. So one is just buying the put. A protective put is if you own that asset, you buy the put, and that gives you downside protection.
Thank you, Michael. We have a question here from Anonymous. If we have an account in Sarwa Invest, can we shift it to trade and sell calls, puts on it? Yeah, so you can make internal transfers between your Sarwa accounts, either from invest to trade or trade to invest and vice versa. So yeah, you can move a chunk of money between your accounts and use it to trade, use it to buy options. That'll be entirely doable. Okay, so we have a question. Does Sarwa provide simulator for checking the profits or losses? Not quite a simulator, but we do kind of give you when you execute or just before you execute the option, we will show you kind of a preview of what, or how, what needs to happen for you to achieve a profit. So it's not quite a simulator, but it's just kind of a sneak peek of what to expect. Okay, we have a question from Dwayne. If I choose not to exercise my option, what fees would I need to pay?
Nothing. You would lose your options premium. That's the only fee you pay is the options premium. If you choose not to exercise, there are no further fees.
Thank you, Michael. All right, we have a question from Rehan. So in Sarwa, is it CFDs that we are trading, investing in? No.
No. They're actually options, so put and call options.
Right. We have another question. I believe we answered this before, but what is the minimum amount of money to trade options on Sarwa? Okay. All right. Can we sell options on ETFs in our invest accounts? Not quite, not at the moment. So invest and trade are two separate products. As mentioned earlier, you would have to make an internal transfer between your Sarwa accounts in order to utilize your funds on the other side. Okay. Will you provide a demo options trading for beginners? Yeah, so we potentially could have a more hands-on, more demo-like webinar in the future. So keep an eye out. We'll definitely be sending communications in case that happens. Plus, I would recommend, so the video that we played earlier is available on our YouTube channel. So if you want to review that at your own time, please do so. Also, our FAQ pages have a lot of resources that can help you specifically with options. Will the record be available after the webinar? Yes, so we will be sending you the recording of this webinar once it's done. If I put money in my Sarwa Invest account, would you handle options trading on our behalf? Not quite. So again, invest and trade are two separate products. So invest, as you know, is a managed and automated investment portfolio where we utilize ETFs. And then trade is where you would be in the driver's seat. You would manage your own investment. So the functionality is not ubiquitous. So if you wanted to use options, you would have to do it yourself on trade. How easy is it to withdraw funds profits from Sarwa? Very easy, just a few clicks of a button. All you have to do specifically on trade is you'd have to liquidate your assets first, and then you can request for withdrawal, which can take anywhere between 1 to 2 business days. And yeah, it's just as easy as clicking a few buttons. Can we see a simulation of a successful call option buy and then we sell when in the money? Sure, we don't have one ready now, but we can potentially guide you through it. So if you'd like, Thomas, reach out to us and we can maybe send you something that will be relevant to your question and maybe go through it via video or maybe send you some resources. But we don't have anything at the moment. We have a question from Kashif. Can we buy Lulu Group shares also through Sarwa Trade? So if it's a US domiciled asset, then yes. So as of now, you'll only find US domiciled assets on Sarwa Trade. So unless Lulu Group is listed in the US, it won't appear on Sarwa Trade. Even on Sarwa Trade, you will not handle the options trading on our behalf. No. So it will be your responsibility to conduct options trading. We won't guide you or interfere in any way possible in general when it comes to Sarwa Trade. We have another question from Anonymous. Is there a fee to withdraw money from our trade account if our bank is not in the UAE? I would suggest you reach out to our customer support team and ask for your own specific case. Usually we do not charge, we don't have any fees or charges for withdrawals. For international withdrawals, there are intermediary fees that are applicable. So I would reach out to customer support and get a more accurate answer for that. Is options available on web interface? Asks Eto. Not at the moment. So we are looking to expand and offer Sarwa Trade on the web, hopefully sometime in the near future. But at the moment, it's only available on the app. All right, Michael, I have a few questions for you then. How can I exercise my option after buying it?
You can just place the order of exercising your option. If it's favorable, then it makes sense to exercise. Obviously, if the strike price is above, the share price is above your strike price and your premium, then you're in the money. Or if it's way above, then you're deep in the money. So definitely exercise, or sell the option and don't exercise. Those are essentially the two options that you have before expiration.
Great. And then a follow-up to that is from Anonymous. Is the option exercised automatically if it is in the money at the expiration?
No. There's no automatic exercising. Investors need to be watching the expiration date. And if you are in the money, it is the investor's responsibility to exercise or sell.
Great. Thank you, Michael. We have a question from Mazen. So in simple terms, if option price rises, we sell it and take profit. Any fee on sale option? Yeah. So in simple terms, if the strike price reaches favorable price, then yeah, you can execute it and take your profit. And the fees will be exactly what we're looking here at the pricing page.
Yeah.
All right. Okay, we have a follow-up question from Dwayne, who asked previously about when can they sell their option. They wanted to clarify, I mean to ask, if I exercise my option the day after buying, can I exercise my option the day after buying, or do I need to wait a certain amount of time before exercising?
No need to wait any time. You can exercise the same day. The options market, as long as the market is open, you can exercise essentially like a stock. Because these are American options, American style options, you can either exercise at any time, or you can sell the option at any time. If you're doing some reading, you'll find that there are two types of options. One is an American style option, which gives you the right to exercise before expiration. And the other style is a European style option, which means you can only exercise at the expiration date. So there are no options to exercise before expiration. It is only one exercise date.
Thank you, Michael. All right. So I have another question for you. So is option trading best thought of as a hedging strategy only, or a standalone trading activity?
Both, actually. You can use options for trading, hedging, if you own the underlying assets, and you can use it as a standalone trading strategy, because you're essentially controlling 100 shares without actually buying 100 shares. And you're benefiting from the price movement and profiting from that price movement of the shares. There are quite a few resources online that shows you different options trading strategies using long calls mainly long calls. There are buying put strategies as well.
Thank you, Michael. All right. We have a question from Anonymous. When I exercise the call option, will I get the underlying asset in my trade account? And if yes, what amount will I need to pay? Yes. So you will have the underlying asset in your account, and the fees that you will pay are as listed here in the pricing page, which is essentially the contract fee and the commission.
Yeah. So if you exercise the option, that means you are essentially buying the stock at the strike price. So then that is exercising contracts. So it'd be 100 shares multiplied by the strike price, and then either $1 or 0.25% of that.
Thank you, Michael. We have another question from Anonymous. Do you have paper trading on options?
No, don't think we do.
Pretty sure we don't, but we can double check for you, Anonymous. Maybe if you want to retype your question without submitting it as anonymous, and then we can get back to you directly. Okay, another question from Anonymous. Would you provide a trailing stop loss?
No, I don't think there are no stop losses in options.
Okay.
Basically, options, your risk is your options premium. Whatever you paid for that premium, if the stock price moves against you or doesn't do anything, and you let that option expire, it becomes worthless. So essentially, whatever you paid for that premium is the risk that you're putting up.
Thank you, Michael. We have a question from Vichy. What are the index options available?
I think you're asking, we have options on ETFs. So if you were looking for an option on S&P 500, I think there's a lot of options on SPY, SPY, or VOO. Generally, if you're looking at larger stocks or large ETFs, there will be probably a lot of option market makers and a lot of options for those options.
Thank you, Michael. We have a question from Anonymous. Is the profit loss that reflects on the Sarwa dashboard the actual profit loss if I were to exit my position for a given options trade? It isn't the actual profit loss, it's an estimated profit or loss. All right. We have a question from Mohsin. Is Sarwa platform available in South Asian countries? For the most part, yes. I would reach out to our customer support or go through the onboarding process to find out if the specific country that you reside in is available to be onboarded on the platform. But for the most, yes. All right. Kashif had asked, sorry, not Kashif, Raja, is daily expiry stock option available? Michael?
We'll have to confirm that if they are available on the platform.
All right, we'll get back to you on that, Raja.
Yeah.
Okay, we have a question from Dwayne. Is the contract price shown on the app 100 times, or would I just pay the amount shown to buy the option?
100 times. So the contract price is for one options, but you multiply that by 100 and then add the $4.
Thank you, Michael. Just typing in another answer to another question. All right. There's a question here. I'm not sure I understand it. Maybe you can make sense of it, Michael. In the long-term options chart for VOO, I see expiry dates as Jan 15 and Jan 16. What's the difference between the two?
Let me see. So looking at this chart and actually looking at the full options chain online, what the difference is, one is Jan 16th, 2026, and one is Jan 15, 2027. It's just in our display, we don't show the year up at the top. So they're different years.
Great. Thank you, Michael. All right. Okay, we've got two more questions. Commission fee and exercising contract fees are incurred if an option is exercised before its expiry. Yes. Okay. And then we've got, what is the max time length of an expiry available? March And then he listed March 2026, 2027 in Sarwa platform.
I believe January, March 2027, depending on the instrument.
Great. Thank you. Thank you, Michael. All right. That's all of our questions, and we're just at time. Thank you, everyone, for joining us. It was a pleasure having you. Again, we will be sending this recording, and if you have more questions or wanted additional information, reach out to our customer support via WhatsApp or email. We'll be happy to answer additional questions. Yeah, thanks again, and have a great evening, everyone.
Thank you.